coffee first. And let's get started. Today we will cover the main news of the past week and talk about ETF flows, job market, equity indexes, and upcoming earnings season. Get comfortable, and small disclaimer, don't forget to like this video and subscribe to my channel. It helps me a lot to promote my videos. Thank you, and let me share my screen and let's get started. Exchange traded funds are nearing record inflows since 2021, as you can see right here, with bond ETFs gaining popularity as investors prepare for the Federal Reserve's potential policy easing. However, purchases of equity and debt funds suggest that investors are betting on soft landing for the economy. So, bonds attracted $312 billion so far, and equity funds $821 billion so far this year, bringing a total net flow over $1 trillion. So let me scroll down. This is. In recent weeks, aggregate and corporate bond funds have been favored, while government bond funds experienced outflows. Investors are increasingly drawn to equity funds focusing on value and blended strategies rather than growth. Additionally, government funds are actively investing in Chinese stocks, in Chinese assets. The ETF boom has also led to record 515 fund launches this year in 2024. So let's move on to the next topic. Okay. In September, a surprisingly strong job market, particularly in construction, hospitality, and public sectors, dampened hopes for a significant rate cut by the US Federal Reserve. The economy added 254,000 jobs, well above the forecasted 150,000. And the unemployment rate unexpectedly dropped to 4.1%. Wage growth also accelerated to 4%. The sectors showing the most growth were education and health services, leisure and hospitality, and government and construction, and so on. As a result, have adjusted the expectation, now predicting 2 rate cuts of 0.25% by the end of this year, instead of a more substantial reduction. The October jobs report due out on November 1st could further influence the Fed's decision making, especially in light of recent strikes and natural disasters. So let's move on. Let's take a look at global indices today and throughout the past week. Here we go. Throughout the past week, European, Asian, and America's market has mostly been in the red, since Chinese President Xi sought to counter the country's economic downturn last month. Investors has calling stronger fiscal stimulus to support one of the largest tax rallies in recent years. But those hoping for a big announcement on Tuesday were left disappointed. The National Development and Reform Commission, NDRC in short, China's economic planning agency announced that only 200 billion yuan, which is 28, I guess, where is it? Which is $28 billion will be allocated next year, wherever analysis had predicted a fiscal package as large as 3 trillion yuan. So let me show you chart. Here we go. After 11% surge at the start of trading session, Chinese stock gave up nearly half of their gains. Hong Kong stocks saw the worst day since 2008, dropping almost 10%. Traders are now reassessing their position as NDRC's announcement cooled the stock market rally. So let's take a look at Hong Kong market. Where is it? Yeah, 9.4%, almost 10% drop. Let's move on, guys. If you need a financial or investment consultation, please visit my website, fill out the consultation form right here, and my assistant will contact you to clarify further steps. I provide consultation in various areas. As you can see, it's financial and retirement planning, education, opening and setting up of a brokerage account in licensed jurisdiction in reliable firms, hedging, which is risk reduction for existing position, investment and trading. I do not provide consultation in taxes and active trading strategies and speculations. Thank you, and let's get back to Bloomberg. Okay. As you may have heard, the yield on 10 years treasuries has climbed above 4%, making this return incredibly attractive, especially given the uncertainty surrounding the upcoming US election and the slowdown in the China's economy. Meanwhile, inflation data remain the same actually, and CPI steady at 2.5%. On this chart, you can see the nature of inflation. The largest contribution are core services, which include shelter, medical care services, transportation services, education and communication, and so on. The rest parts are not that big. It's core good, food, and energy. Last but not least, the US earnings season for quarter number 3 is beginning, which could lead to increased market volatility. Be prepared for potential market swings. So far, as you can see, 45 companies from 381, all public companies in the United States provided their reports for quarter number 3. So let me show you what's happening in S&P 500 index. So just 23 companies from 500 companies provided their report for now. And you can see the growth of the revenue growth of 2.1% and net income growth of 16%. However, since this represent less than 5% of entire index. It's too early to draw any conclusion from these results, but beginning of this earnings report are great. Actually are great. So that's it from my side today. Thank you until then, and spend your money wise.